hey, buddy, I'd like you to pay some taxes in order to pay for a local public school. And you say, I haven't any kids. Why should I contribute to you? And so this is a fundamental debate as old as time. Law of demand says, wherever the price is cheaper, you're going to want more. As price goes up, more people are willing to make those Chipotle burritos. So the quantity supplied will go up. Ultimately, supply will equal demand. Let's say you open up 5 coffee shops in 5 years and they're worth $10 million total. That person's going to get $1.5 million of your profit if you sell all of your coffee shops. Free money ain't free. Hi everyone, I'm Devin Coombs, CPA, MBA, ex-Google and Deloitte, current educator at San Jose State and Ohlone College. I'm also a top consultant for CAOs and CFOs in the Bay Area. And today is your lucky day because I'm going to teach you all about economic systems. I'm also going to teach you about financial controls and the importance of finances in business from an operating and growth perspective. If you have any questions, comment below and feel free to subscribe. So what are economic systems and why the heck am I talking to you about it today? I want to pose you with an interesting question. So let's say you made $1 million. You worked your whole life, never got a handout from everyone, and you made $1 million working really hard, 80-hour weeks. Now, someone's coming to you and saying, hey, buddy, I'd like you to pay some taxes in order to pay for a local public school. And you say, I haven't any kids. I never plan on having kids. And if I did, I wouldn't put them in public school. Why should I contribute to you? And so this is a fundamental debate as old as time. It's curious what you do in this situation. But the answer is there's no great answer. This is the problems of economics and economic systems. So we have one end of the spectrum, which will be capitalist economies, free market economies, a libertarian type of view, and the other end of the spectrum, which are command economies, communist economies, or socialism. One end, you generally think America. Another end, you think China, North Korea and Soviet Russia. Let's dive straight into what are these different systems. The main view here is going to be command, market, and mixed economies. And what we're really going to be exploring is how a society organizes production, distribution, and consumption of its goods and services. And so what if there's a child who's smart and hardworking and just grew up in a tough family? His parents passed away. Now he's 18 and he needs to go to school. Should he get a free college education? And who should pay for that? Should it be the government? Should it be private organizations? Or should he figure it out and buckle it up and do it himself? And so the real question here is morally, what economic system is best for people? And let's dive into some examples. But to understand those examples, you need to understand supply and demand theory. Supply and demand is simple in theory, but pretty complex in practice. So in theory, let's imagine 2 Chipotles. There's one Chipotle that has $10 burritos and another Chipotle that has $5 burritos. Where would you all want to go if the Chipotle burritos were the exact same size? Law of demand says, wherever the price is cheaper, you're going to want more. So as price goes down, quantity demanded goes up. So more people will want the cheaper Chipotle burrito than the more expensive Chipotle burrito. Now, that would be pretty simple, right? People want more things when they're cheaper. There's one more element to the supply and demand theory. As price goes up, more people are willing to make those Chipotle burritos. So the quantity supplied will go up and vice versa. So more people would be willing to make Chipotle burritos at $10 a burrito than people willing to make $5 Chipotle burritos. This will naturally hit an equilibrium, probably let's say $7.50 a burrito or whatever it is today. Ultimately, supply will equal demand. Price will naturally settle here in a market economy. At $10, there's not enough people buying burritos, so they drop the price. And maybe there's too many people willing to work for the burritos, so they're able to pay those people less. And so then they drop the price. And then when it goes a little low, there's too many people who want it, so they raise the price, and then they hit the sweet spot. Market economies are a great environment for an almost infinite amount of these experiences and experiments to be running with each business and in a competitive environment against multiple businesses in order to accurately price products and services. And so that ultimately leads to higher quality of services, better prices for products, competition, and ultimately a higher standard of living for everyone involved. So this matters from an economic system because in a market economy, prices will change based off of supply and demand. So why this really matters is because in a market economy, prices will adjust freely in order to determine the efficient allocation of resources and the pricing of these resources. So you can think of it as, hey, when you were a kid, maybe a worse TV that wasn't high definition cost $3,000. And now you can get a much better version of that television that's much larger for $200. That's a good example of the market economy at work at its best. Things get cheaper, things get better, competition improves, prices adjust to match that competition. Now, where does this go off? So you can think about it, again, from my story, right? I had no family supports. Mom passed away young, all the dark, gritty stuff. I didn't really have any help, and I had no way to really get myself off the ground. I needed some help and some resources. So the government providing things like free education or heavily discounted education, libraries for me to use computers at, all of those were beneficial, and they were paid through via tax dollars or through borrowing from the government. So that is more of a semblance of a command economy. So that's going to help people who need the actual help, and the prices will be set by the government. So a lot of cases, when we think of this, the price might be free, or like the bus ticket might be $1 or a little higher than that. But the idea there is that the government's going to set an artificially low or artificially high price. High prices when you're thinking about things that are detrimental to people like drinking or smoking, in order to try to discourage or encourage behavior. This, however, results in shortages and quality issues. If you're riding a bus, it's probably not going to be as nice of an experience as if the bus was priced in a market economy and was able to charge you a little more. Uber is probably nicer than driving a bus. Or there might be surpluses. If the price is just too high and no one's paying for it because the government made a mistake in the price, let's say they make tobacco cost $100 for each pack of cigarettes, there might just be a bunch of cigarettes on the market that no one ever buys. And so that's not beneficial to the companies making cigarettes, obviously. What happens in reality, though, is really a mixed economy. Some prices get regulated and some are market-driven. This really balances efficiency and stability. So there's command, a planned economy. This is your communist Soviet Union kind of example. And the interesting problem here, as I would like to think about it, is it can benefit people in the short term. So what you're doing is you're essentially taking money away from people who make a lot of money and who are highly productive, and giving it to the government, who then makes decisions to give the money to other people or retain it for itself. This can help the poorer class immediately because you're taking money from the rich and giving it to the poor, but ultimately is a detriment to all of society, because what will happen is rich people, based on the Matthew principle or the Pareto distribution, tend to produce more than poor people, or highly productive people is a more accurate statement. Highly productive people tend to be more productive than all of the unproductive people. Like highly productive people tend to produce a disproportionate amount of goods, and they want to be compensated for it. And if you take their money away, they tend to leave. Once you do that, there's less products and services, which by the law of supply and demand raises the cost of those products and services. There's less for everyone involved, and you, in the long term, actually have a worse quality of life for everyone. So even though most people will get some bump in the short term, in the long run, it hurts everyone. Pros here is they can quickly mobilize resources for national goals. Like, let's say you take all the money from the rich people and give everyone food. Well, that's great in the short term, but in the long term, those rich people will leave. The highly productive people will leave. The government might lack. There will be less choices because less people are making production. And generally, there's lots of shortages of goods that are needed, like food, and surpluses of things not needed, like boots, like left boots or something like that. So in a market economy, we have the other end of the extreme. Imagine no government involvement. We call that laissez-faire economies as well. Decisions are totally based off supply and demand curves in free markets. Private ownership is key. People need contracts and need the law to protect their interests. And government is really just there for protecting yourself from other countries, be it military or a police force. The pros are high innovation and consumer choice and efficiency. Like if everyone gets to keep all of the money from all of their services and products that they create, people tend to be really productive, and it incentivizes highly productive people. But then it leads to inequality. For the people that are just have a tough luck in society, or might have some genetic disadvantages, or just born with a bad hand, they really can't succeed in the market economy. There's also risk for potential market failures when companies get too big And there's less of a safety net just for people in general if something happens. Let's say you have no such thing as health insurance. If someone's poor and they really get sick and there's not enough good care for them, what will happen? There's obvious cons with the command and control system. So where do we land overall, and where do most economies land? Somewhere in the middle. And that seems reasonable, right? Most global powerhouses now have some type of mixed economy where you have government regulations over certain industries like healthcare, oil and gas, and then you provide public goods and services like transportation, building roads, and then you let some other stuff be private, and you hope that you get the best of both worlds. And some countries are more advocates for free market economies like the US. Some are more advocates for socialist economies like Europe. And even China is really a mixed economy. You have some capitalist and free market elements in it, which is why it's been able to grow. It wouldn't have been able to grow without those elements. So this really does balance efficiency with social welfare, but ultimately leads to political disagreements on what should government's role be. Once they take a little, they start raising taxes, sales tax goes up, new taxes come into play, and overall efficiency and debt burdens go up over time. And so the answer here is there's no really great answer from an economic perspective. You just need to understand the pros and the cons. And the best for society as a whole overall is to be as free market as possible while trying to still look out for people on the margins in a scalable way and make sure that they have paths forward. Ideally from private charity, but if private charity isn't there, some government charity could work as long as it doesn't overstep. So now I'm going to talk about the importance of finance and day-to-day business. Let's say you've mastered the supply chain, you've figured out a product that you can charge a profit for, that it is in demand, and that you can supply. Well, what are you going to do with that extra money now? There's a few things that everyone uses money for. First is to operate your business. That would be your day-to-day cash flow. You pay your employees and your suppliers. So that's generally where we all start. Like if you are having a business, you either pay yourself or you're going to find ways to continue your business and have it survive for the long term. After that, you might start worrying about growth. So that could be including expansions, new product launches. For you personally, if it was a personal finance decision, that might be you getting your master's degree. For me, it might be if I have excess cash beyond my operations, that might be investing in a book editor to help me write a book. It's investing in your future ability to make more money and to improve your operations as a whole. Finance and business is key for decision making. Almost every business decision is ultimately quantified in dollars. It's the universal path to benchmark decisions against currency in order to determine if one decision is better than another. And then in risk management itself, personally, the way you can think about this is like health insurance. Once you get your first job, you'll need health insurance. Why do you need health insurance? Because if you get injured or go to the hospital, you can't pay $100,000 every time you go to the hospital. So you get insurance where you might pay $1,000 a month. Then they will pay for you on your behalf if you get hurt up to a certain point. And so what you're doing there is you're changing your risk profile. You're able to say, I'd rather pay $1,000 a month than $100,000 every once in a while. Businesses can do the same with any type of risk that they can find. You could also make the decision of, I'd rather just hold $100,000 cash in case something goes wrong. And then sometimes there's compliance considerations as well and regulatory considerations going back to the government's role in all of this. We need to make sure that banks have a certain amount of cash on hand so that if everyone comes and tries to get money out of the banks, it doesn't cause a stock market crisis because no one can get access to their money anymore. So there's really important aspects of finance that touch every aspect of business, which makes sense if we really think about it. Business is ultimately there to generate a profit. And that's what we're talking about in this class. How would you get money in order to finance your business? The accounting equation. Assets equal liabilities plus equity. How do you get assets? Cash is assets. You can either get it through equity, which is internal financing. You can do retained earnings. So you can generate your own profit to increase your equity, or you can get owners' investments. So you or your friends can invest more in the company, take your own profits and invest it in the company. Or you could sell assets. So maybe the company has a car, they can sell the car in order to generate cash in order to grow or operate, etc. External financing, that's going to be getting loans or bonds, so you can have external financiers. And then you can even think of that as grants. Like the government might be able to give you a grant for a specific research and development project. So you can get funding internally, either generating your own profit. Generally, this is the cheapest type of funding to get, or to fund it yourself, or externally by finding other people to give you the money, but that's going to cost you something. Now that we've talked about what types of financing we have, let's discuss how you would actually go about getting this financing. And this goes back to my RISE framework. Remember, RISE: reflect, set an intention, strategize on how to hit that goal, and then execute and evaluate. Same thing with financing. You're going to evaluate where you are. Why do you need the money? What do you have available now? How can then you set your goals? Why do you need the money? What are you going to use it for? And then allocate funds to those uses. And then once you've identified if there's an incremental need, that's normally when you'd go external. And then choose how you would satisfy that need. Is it going to be debt? Is it going to be offering for new shareholders? Are you going to be looking for a grant? And then you're going to strategize and decide on the best financing source, and then ultimately execute on that and negotiate on it, and then secure the terms and see if it was a good, ultimately evaluate, see if you landed in a good spot. So just to illustrate this, you can think about this from a local coffee shop, but you can also think of this from an AI startup. It works the same. You could have three scenarios. One where you have 50K, 1,000. Let's say we have a local coffee shop that wants to open a second location. Let's say we have a local coffee shop that opens up a second location. They have three options. They can take 50,000 from their savings from the previous business and dump it into their retained earnings. And let's say we have a local coffee shop that wants to open a second location. They have three options. They can either take 50,000 from their savings, their retained earnings that they've saved up over time, and invest in that business. They can take a $100,000 loan at 6% interest in order to invest in the business, or they can bring an investor who contributes $100,000 for 15% ownership. Now, most people here would say, hey, let's get an investor to give us $100,000. And that sounds all great, but they're actually going to be the most expensive over time. Let's say you ultimately open up 5 coffee shops in 5 years and they're worth $10 million total. That person's going to get $1.5 million of your profit if you sell all of your coffee shops. Right? So that free money ain't free. For B, the $100,000 bank loan, that's going to be $6,000 of interest expense every single year, plus bank covenants and bank requirements that they might require you to retain in order to maintain that loan. And then your $50,000 of savings is normally going to be your cheapest option unless you can invest it somewhere else for even higher. But you would want to make sure that you have the risk tolerance and ability to take that savings without destroying your current businesses or your personal financial situation. Now, the complexity of doing these decisions, I always recommend businesses, if they can, scale naturally. That's generally the best for their long-term profitability. But there's sometimes where you might want to scale and leverage faster, which is all by all means well and okay. But that's why you are all learning about this and why you should bring experts into these types of decisions. And then the question is, once we have the money, how do we protect it? And we have this concept of financial controls. So once you have $100,000, $200,000, you'd be surprised. People start stealing, people start lying, equipment will go missing, people will get extra paychecks from nowhere. How do you fix this? You have certain rules that you can follow called internal controls and financial internal controls that can ultimately help make sure your money doesn't disappear. One of the best ways to do this is budgeting and variance analysis. A simple way to think about this is, for your personal finances, if you know that you spend about $3,000 a month, you can check your bank statement and see if it's about $3,000 a month that you spent. If there's a month of $5,000, you go then and check your bank statement and say, this was unusual, and you find you have a weird charge. That's a good example of variance analysis, of a way to make sure that something fraudulent isn't happening on your account. Another way to do this, like alcohol companies will do it, or bars will do it, where they'll weigh alcohol before the bar opens and after the bar closes, and make sure the sales match the amount of alcohol consumed. And if it doesn't, you'll assume maybe a bartender stole, or a customer stole, or a bottle broke, or something like that. Segregation of duties, making sure the people who are handling the money don't also have access to the bank accounts, or who are buying the inventory also don't have access to the records for the inventory. If you need this, or else people will naturally try to take advantage of the system. It's easy to justify why you deserve to keep an extra $100 bottle of whiskey for yourself, or why you deserve an extra paycheck for all that hard work you're doing. It's best just not to give people the opportunity. You can also have internal audits and other fraud prevention measures. And so that would be bringing in external auditors or having an internal audit team to make sure that you have all of these tools and other tools in place so that processes don't result in fraudulent stealing of your money or assets. So that's it for today, everybody. I feel like we covered a lot of ground. We went over economic systems. We went over sources of financing. We went over supply and demand, and even controls for once we get those financing. So we really now understand everything from why people buy things and why we set prices overall, to then once we set those prices, how we make money setting those prices, the sources of funding to take advantage of those supply and demand differences. And then finally, how do we protect that money once we've sourced our finances via financial controls? Let me know if there's anything else you want content on, and we'll continue in the next video.